In election years, we've already talked about this. On average, the stock market's up about, I think, 7.5% if you go back to 1950. So we're well past that. We've blown past that. But I think, there are some cyclical type of risk, short-term risk out there. And, it's healthy for the market to correct and sort of, cool off for periods.
Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, King of Data, Andrew Pratt. Hey, Andrew.
Morning, Casey.
So, you just got off a plane from Ireland, where you watched Georgia Tech beat up on FSU.
Yep, Florida State.
Not really beat up on it. It was a field goal at the end, but that was a good game for Tech. Great game for Tech.
Yeah, it was. We'll see how good Georgia Tech is this year, since Florida State just lost pretty badly to Boston College at home.
Right.
But it's an exciting win, as I just saw, I think yesterday, that Georgia Tech, it's the first time they've been ranked in the top 25 since 2015. I can't believe it's been that long, but
yeah,
it's finally have a little bit of good feelings to start the season for once as a Tech fan.
I went to I guess technically it was my second, but it's my first one in the stands, Mississippi State game, because my son's at Mississippi State.
Oh, right.
And those cowbells, oh my gosh, my ears are still ringing. It was so loud that entire game. Now it kind of fizzled out the second half because it started raining. But the first home game of the season, the cowbells were out. That was something else.
I don't know if you know this. My aunt is actually a Mississippi State alum. So
is she really?
I'm used to the cowbells.
So you're used to hearing the cowbells. That was. I did the whole thing. I went for the walk when the players came off the bus, and then we headed over to. They have like a public tailgate with food trucks and stuff, and then we went to. I guess after that we met up with my son, and then headed off to the game. Now, he did not sit with us.
Right.
He was in the student section, which he said was 10 times louder than
I'm sure
than the other sections. But yeah, college football season. I admit I don't have to watch any college football. Some guys are like, got to be home, got to watch the football games all day today. Right. I'm not that guy. In fact, during the SEC championship last year, my wife she was looking for something, needed my involvement to purchase, It's something for the house. I can't remember what it was, but I was like, we need to go during the SEC championship because there'll be no lines anywhere.
Right.
We walked right in. There's nobody in the store. Yeah. We bought what we need when we left. We're normally, be looking for a service person. So, but I do appreciate it when I have time to sit down and do that. I just got back from Lexington. My daughter competed at the American Eventing Championship. And that was fun. She did well. She got 9th place out of 37 riders. The guy who won was in the Paris Olympics recently.
Oh, wow.
So she was competing with the real pro. She was the only junior.
That's great.
Only junior in the category. So yeah, that was fun.
And she toured Kentucky as well, right?
Yeah. Mm-hmm. Yeah. That's right. We went to UK. I mean, what a great campus. I was really impressed, honestly. Mississippi State's really sprawled out. You have to walk a long way to get to things. I think this campus was all inside like a 2-mile radius. The walking tour was 90 minutes. Business school was fantastic.
Right.
And the library was something else too. The library could be a Smithsonian building, at least on the inside. It's really pretty. So I was real impressed with that. I don't know if she'll end up going to school there. Unfortunately, her discipline and English writing is kind of fading in that area. Everyone's moving to Ocala. So Gainesville would be a better option for her, but I didn't realize their acceptance rate in Gainesville was only 23%.
Really? Wow.
It's like super low.
Wow.
To get there. So anyway, yeah, second child getting ready to go to college. It's definitely making me feel old. So let's kind of dive into our topic today. It's, I get this question a lot, and as well as Missy and Shauna, actually they did the podcast for me when I was out of town. So, yeah, we might get replaced. Yeah. Guys versus girls now.
Right.
We got to bring it today.
We have to have a joint one sometime.
Exactly. So I get this question a lot, and it's an honest question. If you've asked me this question, I'm not cursing you underneath my breath. I feel like it's our responsibility to educate people. But sometimes people ask the same question over and over again, and after a while, you're like,
right,
do you not get it? And the question is, what are we going to do with the portfolio? Since it's an election year, with the upcoming election and the oncoming market correction. So let's break down this question. You're concerned about your portfolio because of the election. So that could go either way. It could be Democrat or Republican. Mm-hmm. There's no independent anymore in the race. So it's either going to be Democrat or Republican, right? So you're concerned about one of those candidates winning. And then your next concern is the market correction that's definitely coming.
Right.
Definitely coming. This market correction is here. It's everyone knows it's
That's
coming.
That's what all the economists were saying. And, I guess we had a little bit of correction in 2022, but, everyone was calling for a big recession, and that did not happen.
In 21, they were calling.
Right.
They've been calling for this since 2021. It is now 24, encroaching on 2025. If you put your money under a mattress with inflation rates, you'd be screwed right now.
Right. Definitely. I think, there's a couple things that we should just sort of lay out first. For one, and I know you know this, is the S&P 500 is up, through yesterday, even after a big sell-off day. I think one of the biggest, of this year. The S&P 500 is still up about 17% for the year.
Yeah.
And then
which maybe that's why people think that there's a big correction coming since it's up. But over the last 2 years, it's not.
And I think, we can get caught looking forward, and obviously that's important, but just look at your portfolio over the past year and even 3 years. I think over the past 3 years, it's about 9%, annualized return. So
and then 10% is amazing.
Right.
Or 10 years is amazing.
Oh, 10 years. Yes, definitely. So I feel like we get caught up in the moment and just need to look at the portfolio's performance over, some longer term horizons. And then also just even this year, like what it's done so far. But in election years, we've already talked about this, on average, the stock market's up about, I think 7.5% if you go back to 1950. So we're well past that. We've blown past that. But I think, there are some cyclical, type of risk, short-term risk out there. And, it's healthy for the market to correct and sort of, cool off for periods.
Well, a couple of weeks ago, we had a NASDAQ was down over 10% in 1 week.
Right.
But it all rebounded.
Yeah. And that's the thing too, is if you try to time the market, and we've talked about this before, is, a lot of times, especially in bear markets, some of the best performing days in the market are in those bear markets. And a lot of this, rebound or price action, reverses outside of trading hours. So if you try to time it and sell, you could, get caught, being in cash or at the wrong time when, if you just left the money invested, you would still participate in that rebound, if the market were to course correct.
So what's that Warren Buffett saying? When the tide goes out, you see who's swimming naked.
Right. Something like that.
Right. Some along those lines, paraphrasing it. You need these healthy pullbacks in the market because people get greedy. Greed sets in, not necessarily individuals, but large institutions, people borrowing millions of dollars to leverage and get a higher rate of return. When the market has sell-offs, those people have to start covering. Right. And sometimes it'll accelerate a sell-off because of shorts and leverage.
And that's, I think, what happened, a couple of weeks ago with that yen carry trade blow up, is people were using leverage to put on this yen carry trade. They were borrowing in low interest rate currency and investing in higher yielding interest rates, or higher interest rate currencies. And because of that, because this trade sort of blew up, that leverage effect sort of accelerated and, caused this unwinding effect, which then, sort of, created ripples throughout the market. So yes, it definitely, events like this kind of show where you're overexposed and, is healthy.
Didn't the Japanese government walk back it?
Yeah, they walked back that. like a couple days later.
Yeah, they're like, okay, we didn't mean to blow up the world. Just kidding. We'll continue to sacrifice our economy for the benefit of yours.
Right.
Oh my gosh. The bottom line is people connect their feelings too much with their portfolios. That's what it's coming down to. Is, oh, I'm pretty nervous about the future. Oh, my political candidate didn't win, and so yeah, we're just going to be screwed. We had a client here who refused to invest because Trump is president, right? And after Biden won, he was like, okay, I'll put my money in now. And he lost a considerable amount of money.
Yeah. And that's the thing. I think, again, don't want to, predict anything, but generally, from what we've seen, and we do have a graphic on this, but if you go back to 1950, in a presidential election year, the market again has performed, averaged about 7%. And usually, and outside of election years, September has been the worst month. But in election years, September through October is where the market sort of peaks. Yeah. And sort of trades sideways. And then October, like I think middle to end of October is where, it sort of bottoms. But then after the election results come in, the market does have a kind of a sharp recovery. And that's just because the market knows the result of the election, and they can sort of, start adjusting to the next administration's policies, and, can go from there. Right now, there's just such a big cloud of uncertainty, whether it's not just election, but like Fed rate cuts and what is going to happen in the bond market. So there's a lot of sort of economic uncertainty out there.
Oh, do you think it's maybe going to be a little different this time, with one side trying to deploy this 25% unrealized gains tax, and which is supposed to only affect people with $100 million or more, right? So there aren't that many number of people that have 100 million or more.
Yeah, I mean,
subject to that.
My opinion on that is obviously that's not good for economic growth, but I feel like that would be hard to get passed through Congress, because I feel like, depending on how the results shake out, whether who's the president or who's in the House or Senate, who has majority control, I just don't see that getting passed.
But I would agree with you. Yeah. If it's we have both parties that are in power in different ways, right. I guess. And I've actually asked Shauna to put together a presentation or a short educational video clip for the YouTube channel, talking about the Harris campaign and what they want to accomplish tax wise, because it's pretty radical. We've read about this before. We've never really had anybody push this hard for it before. That would definitely change things. But so we'll set that aside because we want to focus really just on the markets today. So the bottom line is, and we'll do this a little out of order, Andrew. Ritz-Holtz Wealth Management. If you guys know, watch CNBC, you see Josh Brown on CNBC. Mm-hmm. He calls himself the hood ornament for Ritz-Holtz, and he has some really good stuff. I like that he's out there. He's very New York. He's in your face. Yeah. He's not polite. He's not.
Yeah. A little different.
It's a little different than how we handle things in the South, I guess. But I do admire him and what he's done at his firm. But they put together a chart, and was it actually them, Andrew, or was it? I actually have it here, an image of it on my phone. Let me pull it up to make sure I give credit to the right people. But it was who is going to give you the most money as far as market returns, a Republican president or a Democrat president? Actually, it was Bespoke is who did it.
Okay, yeah.
So Bespoke and Bloomberg put this together. They were just reposting it. So I guess really should give credit to them, Bespoke and Bloomberg here. But if you had $1,000 invested in the market, and they used quite a long time frame, and you can manipulate this to get the data, but all the things I've seen, 50 years, 20 years, this one's 70 years, they all come out about the same. So this is legit. if you invested $1,000 70 years ago, but you only did it when a Republican was president, you'd have $27,400 today.
Yeah, it's
so
it's better than 1,000. But
if you only did it when a Democrat was in office, you'd have $61,800 today.
So a lot better.
A lot better. Which there's a lot of people, a lot of our listeners aren't going to be happy about that. I will say some of the biggest returns were Democrat president and Republican House and Senate. So vote for a Democrat president and vote for a Republican senator or congressperson, but no one thinks that way. Most people just vote their party ticket.
Right.
And so it's the midterms that people get angry about their presidential vote and they switch the House and Senate.
And that's where, we have a divided Congress, that's where markets like less uncertainty because, that way it's harder for, and I don't say extreme, but it's harder for, whether it's Democrat or Republican president to kind of push some of these policies through. And then having a divided Congress sort of helps sort of mitigate some of those, I'd say more
extremes. Yeah, exactly. So here's the kicker. All right. So refresher, $27,400 in your pocket. If you invested $1,000 70 years ago under a Republican president. If you were investing only during Democrat presidential years, you had 61,800. Here is the party that I vote with. If you just kept your money invested the whole time, Democrat and Republican, you had $1,690,000.
That's a lot better.
Isn't that crazy? Yeah. Over the last 70 years, $1,690,000 versus 61,000 for a Democrat, 27,000 for a Republican president. The bottom line is you have to stay invested. You have to stay invested. It doesn't matter who politically, it doesn't matter who is in office. And we say this on our podcast. We say this face to face with client meetings. You just have to go through the process of investing.
Right. And I think it also kind of points back to, and we've talked about this, is, when people get spooked about.
And this is the S&P 500, by the way.
Right. Yeah. Getting spooked about getting near a top in the market and then going to cash. Again, if you miss like the 10 best days, and again, all these scenarios, there's lots of different scenarios out there, but you can, significantly hurt your return. So, kind of this sort of ties in together with this is just stay invested, ride out the short-term noise and just maintain the course.
Yeah. We all think we're smarter, that we're somehow going to pull money out and we're going to time this thing and we're going to stop the pain. And I'll give you a solution to all this here in a minute. But the first thing you should be reading is The Psychology of Money. Morgan Housel, Housel, Psychology of Money. Timeless lessons on wealth, greed, and happiness. As you can see, I've read the book multiple times. I have markers in there because sometimes for blog posts or something, I go, Morgan had a great quote on this. I need to pull this out. But yeah, you need to read this book. If you think that you can time this stuff, and if you think that you are smarter than the markets, or even if you're just nervous about money in general, and what's happening in the markets, The Psychology of Money is something you need to read. We've all read it here. It was a required read here at Wiser for everyone who touches client dollars. And I think we even had a podcast on it probably a long time ago. This is episode 243. We've probably talked about everything at this point.
Yeah.
But that was certainly a whole podcast when that book came out a few years ago. So, all right, let's go back up. And so the first part is the election has nothing to do with your money. If you want to make sure that you're always in a position to win, you have to be in a position where you don't have to access your money for a couple of years.
Right.
And we do this ourselves. Mm-hmm. We do this through our investing philosophy for those who are retired, who are drawing money monthly. And that's our cash bucket system, using at least 2 years worth of cash as a reserve. So the idea is the client has emergency reserve on their own. That's usually between $50,000 and $100,000, depending on your lifestyle. and how many homes that you own, how many cars or planes you got, right? That number will change. Then if you go to beyond that, you think about your monthly withdrawals. So if you're pulling out $5,000 a month, then you would have $120,000 in reserve. So that's your cash reserve for your income. So if the market completely tanks, because somehow in this question that I get asked frequently, they know the market's going to fall apart. They know it, just know it. And well, if we just know it, we got to be prepared for it. So we're not going to be prepared for it by moving your money to cash, right? The investment side, we're going to be prepared for it by having a reserve. That means that we can pull from this reserve on a monthly basis without ever having to touch the money, to allow the money to stay fully invested. Because we know if we do that, we have a 98% chance of long-term success, according to the S&P SPIVA report that comes out every 6 months for the last 20 years. Basically said the same thing for 20 years.
Yeah. And that's, what we're doing is the clients that are taking withdrawals to live on from their cash bucket portfolio, we're kind of replenishing that portfolio when the market's up and good times. And then when the market is down, we are just pulling from that reserve. And that way we're not selling equities at, the worst time.
It seems pretty simple.
Right.
And it works really well. In fact, I feel like as a whole, the client base has really changed their mentality on this over the last 10 years. And I think we've done a better job in our planning process to educate people. I think that's a role of a financial advisor who's not selling stuff like us, is to educate. Right. And some people don't care. They're like, oh, we trust you guys. You just take care of it. And that's fine. It's kind of boring, but that's fine. Some people challenge us. Yeah. And I like those meetings because, knowing that we're right.
Yeah. The proof is in the pudding.
Yeah. Knowing that we're right is, I said this earlier. I don't know how people have conversations with their clients, how advisors have conversations with their clients when they're just really just selling products, because you can't really defend that.
Yeah.
Really. And that's how we get so many clients, I think, is a lot of people just don't trust advisors. And so they find us and they come here and we sound different. We talk different.
Right.
But anyway, so the point here is your money needs to stay working for you. Even if the market's falling apart, you're still getting income. You're still getting your dividends.
Yes.
We can't time it. The psychology of money tells us that we need to do this. The S&P SPIVA report says that we need to do this. It's all math. What we don't talk about is our feelings. And it's okay to be concerned about the market and what's happening, but you should have a system set up where it doesn't steal your joy, and yet you're still able to live your lifestyle no matter what. And that's in the planning process. The planning process, we stress test every single client here. We know that we can get through the financial crisis all over again, 07, 8, and 9, and the clients will not have to change their lifestyle.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
Yeah. And I'll just, speak to an example. My previous employer, I was one of the analysts on a team of 10 analysts, all CFA, and we would underweight or overweight equities depending on several, pretty rock solid economic indicators. And, I'll say they got burned by going underweight. All these indicators were signaling recession. They had never been wrong before, but they were underweight most of, domestic and international equities for, I think 2021 and 2022, and then going into 2023. So, it's just very difficult to time the market. And, not trying to talk down on them, the rest of, prominent economists were, speaking the same language. So it's, it's just very difficult to time the market. Our financial plan incorporates volatility and recessions into the investment model recommendation. So it accounts for all of that. So, whatever the financial plan, model recommends to get you to your, long-term financial goals is, been tested and, accounts for all the volatility and noise.
So transitioning off of that, the next part of the question is, with the coming market sell-off, which is always happening. Eventually you're going to be right. Eventually the market does sell off and you're like, I knew this was going to happen. You called it 10 years ago.
Yeah.
You missed out on.
There's a fund manager. I think it's, I can't remember his first name, but Hussman. He was a big bear market fund manager, but he was calling for a bear market every single year. I think from like 2008 until, finally he
finally got one.
2020.
Sorry. So let's talk about market corrections and what their causes are. So what are, there are indicators out there. There are things that show, but what you see and what you feel in real life is not always what's happening in the markets. The markets are typically kind of looking 6 months out. The market lives 6 months ahead of what you're seeing.
Right.
And that's a good rule of thumb.
Yeah.
So what gets us to a market correction?
So, there's a myriad of economic indicators and data points out there. I will say every recession has been caused by unforeseen catalysts. So, it's hard to predict recessions. But, there's secular market cycles and cyclical. Secular is more long-term, 3 to 5, even longer. I'll say we're in a secular bull market right now. Cyclical is more, timely with macroeconomic data and then just like the election cycle. So more of shorter term, 6 months or less, or even like 1 month. So, obviously there's different things like, we talked about the yen carry trade. That was a global macro event that caused, a brief sell-off across the global equity markets and bond markets. But, all these different data points with unemployment and, there's just, again, I see positives and negatives currently. It's usually a mixed bag of, negative and positive data points. There are some indicators, that I was talking to previously that have never been wrong, that have always preceded a recession. Still technically signal a recession, but, I would say that, for instance, like the yield curve, where the shorter end is higher, the shorter bond curve has a higher interest or higher yield versus the longer end, going like 10 years out.
The inverted yield curve.
That's been inverted, I think, for almost 2 years now. So it's,
when that happened, people are like, people on CNBC, right? They're entertainers, by the way.
Yes.
So CNBC is like, we have an inverted yield curve. This always signals a market recession. So I started researching that. Well, how long is the recession happen after it's been signaled by inverted yield curve? It's anywhere from 2 months to 8 years. 8 years.
Yeah, I did actually a lot of research on this. And, I think I went back the past 5 recessions, and I think, the 3 month, not to get too technical, 3 month and a 10-year, which is the most accurate measure of this yield curve inverted spread. I think it was like 16 or 18 month median average before, when this inverted before recession happens.
Right.
So we've obviously eclipsed that time horizon, but to me, it sort of means that the economy is more prime for something to break. Not that it's going to break. I think, kind of what happened this time is we had this exogenous growth shock with AI and technology, and that sort of pushes up the growth curve. And then sort of, we had all these different failure, with the regional banks, were collapsing in March of 2023. And we had all these other different shocks, but, the economy stayed resilient, growth continued to move forward. And we sort of pushed through some of these, bigger catalysts that have happened. And not to say that something might still happen, but to me, on the positive side, I feel like we have a strong equity market. We might experience a sell-off, which is still very healthy, but profit margins for U.S. equities are still very high. Growth is still very high and beating expectations. So I think obviously growth is the strongest indicator of them all for equities. So I still think, yes, we could experience some short-term noise and have a sell-off in September, which is very normal any year, and also just leading up to the election. But I think we're still in a secular bull market, and I still see that equities will, finish out the year on the positive side.
So that's all very short term.
Yeah, it is.
I mean, we're recording this in September, beginning of September. And if I look at our financial planning software, it doesn't even take into account like fraction of a year.
Right.
It always thinks in terms of annual. And you go out, and for most people, we're planning to age 95, some people 100. It just doesn't matter. Doesn't. I mean, we have the cost of the portfolio is around 10 basis points or 0.1%. We have we use mostly low cost index funds, or if they're active strategies, they're very low cost active strategies using an ETF wrapper. And so in the end, it's there's no secret sauce here.
No.
You're not going to go to some active strategy and end up with a better rate of return. I don't think.
No.
You can't. I often tell people there's things you can do to a portfolio to kind of juice it up, maybe over a 3-year period. But beyond that, everything returns back to the average. Yeah. I mean, you see that in the S&P 500.
Right.
No one can beat the S&P 500. That's why it's one of our largest holdings.
Yeah. I mean, it's very hard to make timely tactical calls or even just, investment allocation decisions that have positive performance attribution. So, when we make changes, it's something that has a long-term thesis,
5-10 years.
Yeah.
Yeah.
And, or something that, we believe, again, in the long term, like adding digital assets, having a digital asset model for clients that are interested, we're firm believers in that over the long term.
Yeah.
So it's changes like that we make into the portfolios.
So the capitalism versus political parties. I think in the end, Coca-Cola is going to keep selling Coke. Delta is going to keep selling seats, no matter who gets elected.
Right.
I don't think anybody's running on a ticket to shut down private industry. Mm-hmm. Now, it may sound like there's a public war. I mean, if you make over $400,000 a year, right, you're public enemy number one for the Democrat ticket right now. Somewhat neutral, I guess, on the Republican side, but tax, how we pay for things in the future, all that is probably wrapped up, obviously, in who gets elected. But as far as your portfolio goes, we need to buy companies that make money.
Right.
And majority of the companies make money.
And they'll find a way. I mean, if there's
or they'll go out of business.
Yeah. If there's unrealized gain tax or whatever, some more regulation. I mean, these corporations are smart. They'll find a way to navigate that.
If corporate tax goes up, guess who pays for that? You pay for that. You think the corporations are paying more in tax? Right. Absolutely not. You're going to pay more for the goods.
Yeah.
It's going to get passed to the consumer. Mm-hmm. So then you have inflation. You have all different kinds of problems.
Right.
So it's corporations got to pay their fair share. Like, well, who pays?
Yeah.
who's buying the product? You are buying the product, Mr. Consumer.
Oh, I saw an anecdote. I can't remember the specifics, but it was someone, I think it was complaining about Kraft Heinz, like that their revenue increased like several 100%, but then I think their profit margins actually like decreased. So it's like, no, they're just trying to keep up with the cost of their goods. It's not that they're actually making more money. They're just trying to, offset the inflation costs.
Right. Right. Yeah. But it's all Target's fault because they price gouge people and charge more for things. And it's people don't understand economics. That's again, read The Psychology of Money. Understand how this stuff works. Another good book is A Random Walk Down Wall Street. That should be a textbook everyone reads in business school. We subscribe to a lot of that investment philosophy at the tail end of the book. The first part is the history of the stock market, which is pretty neat. You can learn about tulip crashes and all that stuff. But yeah, I mean, it's all right. So if you walk up to me and you say, hey, how are we going to handle this portfolio with the upcoming election and this big sell-off that's coming in the stock market? The answer is the elections don't really have anything to do with your portfolio. You own 6,700 stocks. You own 12,000 bonds. There's going to be some in there that lose because the Democrats in office, or some that lose because the Republicans in office. The bottom line is, doesn't really matter to us. Because, when you're buying low cost index funds, you get a little bit of everything. If we were stock picking, that might be a little different.
Yeah. And I will say one kind of value add that we provide is, for taxable accounts, we will look to rebalance if it's, meaningful to do that, in down markets and look to tax loss harvest for those taxable accounts.
So that answers the second part of the question. What are you going to do with the pending sell-off? All right. Yeah. Well, if there is a sell-off, which people have been calling for a long time and it hasn't really happened. We did in 2022, obviously, but it hasn't really happened. So if there is a sell-off, here's what we're going to do. We're going to rebalance your account. We're going to take the bonds that went up in value. We're going to take the profits from those, and we're going to buy more stock, which is a lower price.
Right.
Because you want to buy low, sell high.
Right.
Doesn't feel like you're doing that in the middle of the crisis, but yes, we'll buy low, sell high. That's what we're going to do. And then if you have a larger portfolio with us, you're probably doing direct indexing. Direct indexing is going to be spinning its wheels really fast, where instead of buying the ETF, we actually just build the S&P 500 in-house, right? And then we own the individual securities, and then those securities will sell off. We tax loss harvest those for similar securities, sell Coke, buy Pepsi kind of a thing. And we end up creating these huge tax credits to be used when times are good and you have capital gains, et cetera. We also will take opportunities to just look at overall what we call long-term healthy asset classes. And should we be adding more to international or adding more to domestic, or should we be adjusting the bond portfolio a little bit? There'll be some small tweaks, but never out of my mouth is going to be, let's go to cash. We got to go to cash, because that's fear.
Yeah.
And fear, only thing fear does is take money from you.
Yeah, and I think it's hard to make these broad underweight equity, even overweight equity calls, because again, you can get burned on both sides of that. So it's really just to stay,
if you start going to cash and decide, here's the most common thing I hear on cash. And I haven't heard this in a few years, but mostly during COVID. But it was like, well, let's get out at Dow 30,000
price target. Yeah.
If it goes all the way down, but when it comes back up to Dow 30,000, we'll just get back in. So we'll just miss this blip. And it doesn't work like that. First of all, no one's actually invested in the Dow. Everyone's invested in the S&P 500. But let's say you did the same thing with the S&P. The market doesn't work like that, because you could and I'll go back to the Dow because everyone knows it. But if the Dow is at 40,000, tomorrow it could open at 35,000.
Right.
What happened to the 5,000? You had no opportunity to trade on the way down to the 5,000. It just opens that way.
Right.
The market does not open 24/7. There's early trading, there's late trading, but the reality is, on the way back up, typically the market opens up 500 points or 1,000 points. Well, if you were in cash, you missed that jump. And if you missed one of the best days, as you were saying earlier, you can be missing 25, 30% of your total return for that year. And it gets worse.
Yeah. And I think, going back to that yen carry trade blow up, that happened earlier this month or earlier in August. The NASDAQ was down, I think 10%, but I think, after, through their fall on Friday, it was like almost flat, I think, or maybe it was like slightly down. So, I mean, you could see how fast that came back and back to almost even.
Right. By the time you process, I'm going to go to cash, and then you say, okay, when should I get back in?
Right.
And it's already above where you got out. That's how you lose most of your money. There was a Vanguard report many years ago. Average rate of return of the S&P 500 was like 8% over a 20-year period, 8% per year. The average investor has 4%. And they attributed to the difference between the 4 as a behavior gap. It was people screwing themselves by trying to time the market, or they would go to bonds. They would stay invested, but they go with the bonds at the worst time. And then they would come back out of bonds to stock at the worst time, all based off of feelings, not data.
Right.
You want to invest based off data. That's why you hire a financial advisor, to someone who's looking at your financial life, not with emotion, but with a solid understanding of how money works.
Yeah.
And what's the highest probability of success, and how can we get your best lifestyle with the least amount of risk? That's what a financial advisor should be doing.
And I mean, behavioral biases are a big factor. I mean, we studied it in CFA. I know there's certifications out there for advisors on behavioral finance. I mean, it's definitely a big part of the investment or investing.
Absolutely. Schiller, is he at Princeton or Yale? He's at Yale. So Professor Schiller had a whole class on behavior finance. I actually audited that online back when Apple used to have Apple as education, Apple something. Oh. They don't have it anymore, but you could audit these different classes, or maybe it's just podcasts now. But actually, that was because I didn't have behavioral finance when I was in college, and I wanted to learn more about it. And that was very eye-opening to me. Yeah, is how much noise, market noise, is just based off of sometimes irrational behavior, right, of individuals. All right, Andrew, thanks for the chat today, and hey, don't be afraid to ask that question to me. Hey, I'm concerned about that coming election and the pending market correction. I'll just refer you back to this podcast. We've got some other things that you might want to listen to. We have a YouTube channel. It's called A Wiser Retirement. Pros and cons of dividend investing is one we're linking to. Does lump sum investing beat dollar cost averaging? That was a highly watched one as well. As far as other podcasts, episode 225 with the 2024 presidential election influence the stock market. If you want to dive deeper into that, Andrew and I did that episode just a short time ago. Episode 182, investing for the long haul, creating a retirement-focused investment strategy. That was a good episode as well. We've linked those. We also attached an image about this election years, or election years tend to peak around September to late October. So if you want to see that chart, we put that in the data as well. Thank you for listening to the podcast. Our podcast is getting a lot of traction lately. So welcome to all of our new listeners. You've got 242 episodes to catch up on. So you got plenty to do. Anyway, thanks for listening. If you want to learn more about Wiser Wealth Management, or want to schedule a time with one of our financial advisors, you can do so by clicking in the episode notes or finding us at wiserinvestor.com. Thanks. Have a great day.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced by Rachel Dotson. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.